So what you're seeing in the market is it's eerily quiet on the data front in the sense that volatility is very low. But that also means that there's a lot of heightened risk, be it through European politics, Brexit, China-US trade relations, and also obviously the Fed. With the Fed, we're expecting really two main focus points, whether it's going to be on the dots and the bonds. Mainly with respect to the dots is, are they going to move the dot plot down to reflect the fact that there's going to be either 1 or 0 rate hikes left in 2019, and as well as whether or not we're going to get some balance sheet explanation as to what their intentions are for the remainder of the balance sheet for 2019 and beyond.
So let's talk about those dot plots, the forecast that Fed members have about where they think interest rates will be. What is your expectation, and how have you positioned your portfolio and investments to either take advantage of or prevent against something on those dot plots happening?
Sure. So in our view, we believe that the Fed's likely to, or Jerome Powell is going to double down on what his messaging was at the last meeting, and that was to exercise patience. They have time on their side. Inflation is low. The data points that have been coming out of the U.S. have been mixed at best. They've been, marginally good from time to time. So the expectation is, from our perspective, that the front end of the yield curve remains extremely attractive. The likelihood of future rate hikes is virtually been pulled off the table completely. And what that means is that if the Fed's no longer hiking interest rates for the remainder of 2019 and beyond, the next move is likely down. Now, what that means for the rest of the global central banks across the world is that they're likely done as well. So what you're seeing is the Fed leading the charge, exercising patience, no more rate hikes for 2019 and beyond, the next move down, and then all future central banks on hold for the foreseeable future.
All right, so if that is your view, then, does that mean that we now have an all-clear signal for risk assets? I mean, this idea that most central banks will follow the Fed's lead, and perhaps if there is a cut to rates, isn't that bullish for risk-related assets?
It can be, and I think if the Fed messages it correctly, I think the big thing the Fed needs to do is not send mixed messages. They need to remain transparent. And that was one of the issues that we encountered in sort of late 2018, where we were getting these mixed messages from Powell and company. So as long as they remain transparent, it can be bullish for risk assets. So front end of the yield curve remains attractive. Risk assets will do well. We also expect a further steepening in the U.S. yield curve also.
So how does this play out then with regard to credit versus sovereigns? Is there an opportunity more on certain parts of that bond market right now? I say that only because we've seen such a huge rebound in things like investment grade corporate here in the U.S., also high yield as well, from those lows that we saw back in December. Does that mean that we're supportive of that kind of fixed income investing as well at this stage?
Sure, absolutely. And I think that high-grade credit, high-yield credit will stay relatively buoyed. It doesn't mean that you're going to get significant capital gains or spread contraction from the assets that you own. But like you said earlier, you're actually encouraged to take on risk assets, so you might as well capture that carry. Again, the focus needs to be placed on the front end of the yield curve because there's no need to extend and take excessive duration risk. So one of the things that we look at is that, are you being compensated for moving out the curve? And you're not. You can essentially create a portfolio that has roughly 90 to 95% of the yield by focusing on the front end of the yield curve by taking only about a quarter's worth of duration. So why take that extra interest rate duration when, like I said, the Fed's giving you the all clear button? They're encouraging you to take risk, take assets and buy at risk assets, but also focus on the front end where you could get further rate cuts down the line, but also a benefit from that duration, that roll down to maturity.